This afternoon, my guest is John Larson. John Larson is with American Real Estate Investments. They work with investors who want a hands-off investment in markets like Dallas, Houston, St. Louis, and Kansas City. And this is with respects to turnkey real estate. John, welcome to the program.
Thank you so much. It's a pleasure to be on the show.
John, if you don't mind, if you could take just a minute and kind of tell a little bit about your background, a little bit about your company for our listeners, and then we'll get into this.
Yeah, sounds good. So I've been involved in real estate in some fashion since I was a teenager. My uncles are really big real estate investors. They've been building rental portfolios for themselves for years. So in the summers, I used to work with them on homes and, do kind of a lot of the grunt work and manual labor. So I really started to learn, what went into these flips and how to flip a property and things of that nature. And then went away to college, studied marketing, and also my university offered a minor in entrepreneurship where I learned a lot there about how to run a business. Actually, part of the process of the minor was to actually start a business yourself. So coming out of college, I got my real estate license. I started working as a real estate agent in Birmingham, Michigan, at a luxury brokerage. It was actually the number one brokerage in Michigan, Max Brook Realtors, where we sold high-end properties, bought and sold high-end properties. And the thing with Michigan is, it's a market that, it's hot in the summer, cold in the winter, and there's not a lot of action going on in the winter. So I was looking for a way to generate more income. And so I started working with investors because no matter what time of year, investors are looking to buy and they're looking at numbers. They're not buying on emotion necessarily. So I started getting involved in rental properties specifically. And we were coming out of that or just kind of getting in and out of that recession period where you could still buy properties at a very, very affordable rate. And so we were doing a lot of properties in the city of Detroit and around the city of Detroit. And so my first experience with rental properties was in that kind of lower end. $40,000 to $70,000 properties that rented for $600 to maybe $800, $900 on the high end. And I really learned a lot about what not to do. There's a lot of bumps and bruises on the way of just operating in a very distressed type of area, an area where I wasn't getting the best type of tenant in my properties and in my investors' properties. So, I kind of pivoted away from that, and I met up with American Real Estate Investments because they were operating really big time out in Missouri, in St. Louis and Kansas City. And St. Louis and Kansas City were similar markets to Detroit. Coming out of the recession, a lot of vacant properties, a lot of opportunities, a lot of foreclosed homes, and the numbers looked very similar to Detroit. So we started buying a lot of properties in that market as well. Through that, I met up with the guys at American Real Estate, and I actually made a trip out to Missouri, met with them, and they told me about what they were doing down in Texas. And they were doing more of what we call an A-class opportunity, investments that rent at a higher rate, and obviously more thriving economic markets. When you talk about Texas having the second most Fortune 500 headquarters, 23 of those headquarters in Dallas-Fort Worth, 26 of them in Houston. Dallas-Fort Worth has over 10,000 corporate headquarters, which is the most in the country. And when I got down and they showed me what they were doing in Texas, I was blown away. Coming out of that recession, you're looking at properties in good middle-class neighborhoods that we were selling to our investors and funds at that time. A lot of funds were buying properties. We're selling homes for $120,000. They're renting for $1,200 in really beautiful neighborhoods that are newer built properties. So I was like, look, I need to be a part of this. So I jumped ship and I started working with American Real Estate. We were headquartered in Kansas City at the time, moved the company down to Dallas in 2014, and we've been off and running ever since. We kept our footprint up in Missouri. That's more of our B type of market. So those would be properties that are valued on average at about $100,000 that rent for $1,000. And then down here in Texas, it's more of our A-class properties where we're producing homes. I just sold one to an investor for $290,000 in Burleson, which is a southern suburb of Fort Worth. That's going to rent for $2,300 a month. Still positively cash flows, but great appreciation play. Obviously, at $2,300 a month in a nicer suburb like that, you're going to get a great tenant, and it's just going to be a really safe, stable investment. So it was the attraction of getting the opportunity to come down and start doing some higher end properties that I believe in and I know work. It was that combination and just the fact that, I believe in this Texas market. So when I had that opportunity with American Real Estate to jump on board, I definitely took it.
Well, that's a lot of a lot of work. I mean, from doing the grunt work to moving down to the A-class properties down in Dallas and Texas, and it sounds like you've definitely seen the spectrum there. I want to talk in before we jump in here. I want the kind of listeners to know. Our program is called Commercial Real Estate Pro Network, and even before we jumped on the call, John and I were talking about it. Is the opportunity to develop, whether it be you start with one property and grow that and leverage on up into some larger things, into some more commercial, or even grow a portfolio of single-family properties to where it's a real business. I don't want people to think that we don't talk to people that do single-family, because that's clearly not the case. We will, but it's more about the business focus is kind of what we're looking at. And clearly, you guys are operating a lot of volume there. In fact, if you don't mind, can you tell or speak to about the volume you guys are doing?
Yeah, I could be doing a lot more as well if I could get my hands on more single family opportunities in Dallas and Houston. But last year we sold, I think, just over 250 single family homes, and that would be across all 4 markets. Like I said, if I could get my hands on more opportunities down here, I could probably do well over 300 a year. It's just in today's market, it's clearly a seller's market. Banks have been loaning. They've been loaning again at cheap rates, so we have tons of buyers out there. And the neighborhoods where I'm buying in, these aren't investor-owned neighborhoods. These are neighborhoods where there's also owner-occupants that are trying to buy these properties, and they're willing to pay, market value or above for the home. They don't care how much it rents for. They don't care what the rate of return is. They plan on living in this property, sending their kids to that school district, and staying there long term. So that's another thing that I look at with single-family homes. You have a multiple exit strategy with single family. I like commercial too. I like all investments. I believe in diversification. I'm just running a company that more so specializes in single family. But, I've had experiences as a young man, and I've seen other people in my family and other, people in the industry where you have multiple exit strategies with the single family homes. If you want to sell the property to another investor with a tenant in place, they're going to be willing to pay you, based on what that property is generating as far as ROI. Or, I've had circumstances where I saw that my property appreciated $50,000 over 3 or 4 years in Texas, especially. And after that, I decided, you know what, I'm not going to renew the lease on this tenant, and I'm just going to put the property on the MLS. And I sold it to a home buyer who was willing to pay me market value, not an investor who's looking at the numbers.
Right. So in your numbers there, like the 250 a year, is that where you're directly placing properties with investors? Is that your primary marketplace, or are you also selling to home buyers, or somebody's going to live in a home?
Yeah, that's a great question. So the market today, if you're buying in good middle class neighborhoods and above middle class neighborhoods, inventory is low all over the country. But especially in a market like a Texas, where 1,200 people a day move to Texas, 400 specifically to DFW and Houston. So when you're talking about that type of population growth, obviously you're going to have some inventory constraints. And so what I've started to do to keep up with demand is I have almost like this hybrid acquisitions model. It would be a property ARV, after repair value, 300K and below, that if I can't sell that home to an investor, I can always sell it on the MLS to a home buyer. So I do a little higher end renovation because I'm also buying in nicer neighborhoods. And anytime you're renovating a property, you got to make sure it's, look at the area. It's gotta conform to that area. So if I'm gonna, like the house in Burleson, for example, that rented for $2,300, I put granite countertops in and all this other high end stuff that I wouldn't normally put in on a lower end rental, but it's a little bit of a different strategy for my investor. It might not be a long-term hold strategy. Maybe it's a short-term hold strategy, and you're just going to try and ride that appreciation wave, sell it in 3 to 5 years, cash in that equity, or maybe they just do a cash out refi and buy some more properties with that money. So it just depends on where you're acquiring the home. But yeah, I added this new model in where it's not just directed towards a rental type of neighborhood. It's something that, hey, I'm going to give the opportunity for my investor to come in and purchase this home. And many investors from California like that appreciation play because they were so successful with it in California in their own backyard. Now I see a lot of California investors 1031ing those properties into multiple homes out here in Dallas, okay, or Houston. And so they really like those higher end properties in the nicer neighborhoods. And they're not as concerned with the cash flow. They're looking at it like, okay, is the tenant, and can I get a loan on the home? And is it going to appraise at what I'm purchasing it for? And then is the tenant's rental income going to pay all my bills and leave me a little less left over in case something happens? And I just hold it 3 to 5 years, like I said, and hope that this thing continues to appreciate the way it has been historically. And so that's why I see a lot of other investors. There's some people that just want that ROI, the high cash flow, high rate of return, but then there's other investors that have had good experience with that appreciation play.
Let me ask you, you mentioned earlier, and I can't remember if this was before we got on the call or not, but the experience with some of the lower end properties. Can you speak to that? I think, a lot of people that get kind of seduced by the real estate bug is kind of the, it's that low cost of entry and this huge cash flow, but the risk maybe not as clearly understood.
Yeah, one of the guys I know that said it best was Jason Hartman. He said the myth of the $40,000 investment. It's truly a myth. I mean, it's very tough to manage those type of properties. It's very tough to get a professional management company to look after those type of investments. They want to feel safe in the areas that they're managing and things of that nature. And usually if you're producing C and D class investments in really rough neighborhoods, you're going to be dealing with a C and D class property management company. And as I said, the money is really won and lost on the management side of it. And it's really won and lost on the type of tenant that the property is going to attract. So by us doing these higher end properties in Dallas and Houston, and even up in Missouri and St. Louis, I'm really targeting like the true middle class neighborhoods up there too. You're talking about $100K to $130,000 properties on the high end. That is kind of like your entry level middle class up in Missouri. It really is. So I'm still getting some solid tenants up there as well. But this one in Burleson at 2,300 a month, a house that's almost valued at 300,000. That's a really nice neighborhood for a Texas type of property because the median home price down here in DFW specifically is about 260. In Texas as a whole, it might be up to about 230 right now. So we're above that median home price. We're just getting better quality tenants in the property. And so on the flip side, though, I've had experiences with high end properties, right, where those tenants can kind of be a pain as well because they're just calling and making maintenance requests about every little thing. So you got to kind of find that happy median. And I've just found in that true middle class to a little bit above middle class, you're dealing with just a really good tenant that if something breaks, many times they're just going to fix it themselves. Why even call the management company, Right. And so I've just had a lot better experiences. So have my investors with that type of, class of property.
Right. No, keep the yard mode and kind of a pride of may not be ownership, but they want to, fit in the neighborhood and kind of keep everything looking good and all that.
Exactly. They're having friends or family over or the neighbors they make friends with. You think they're trying to have a crummy looking home. No, they're taking care of that property.
Right.
So it's all about the type of person that you're going for. And like I said to my investors all the time, I'd rather take, just stability and consistency, literally like a flat line, than something that's going to be a high peak, high valley or low valley type of investment where you're all over the board. My investors come to me because they want something passive that they don't have to worry about, that they just look in their account each month and there's my rent check. Right. That's what we're able to provide our investors. I just said to one of my guys, my investment coordinators, he was getting frustrated. He's like, John, all the guys that are calling in, it's like they're comparing us to every turnkey provider in the country. And I kind of laughed and I chuckled and I said, look, explain to them that we're the Mercedes-Benz, okay, of these type of investments, and they're trying to compare us to every other used car lot around the country. That's really what they're doing. What we do is something different than most of these turnkey guys around the country are able to provide. They're looking for the people that are chasing the high yield, and like I said, high yield, high return is going to always be associated with higher risk. I'm looking for something that's going to get you positive returns, but then also be something that's stable, low headache, low problems, and very passive.
Got it. Let me ask you, you mentioned the income, or not the income, but the median prices. How does that track with the median income? And you mentioned somewhere between 260, I think 260 was Dallas and 230 was Texas overall.
We're looking at about 260 in DFW right now. It might even got up to about 270 at this point. The median income in those neighborhoods, so my true middle class tenants, the true middle class areas that I'm buying in, I see the applications, they're making 60, 70K on average, and 68,000 right now is the median income for the DFW area, and it's very much in line with Houston also. Houston's a little bit lower on the average home price. It's just a much larger city. So it's kind of kept prices in check a little bit more, even though they're experiencing a lot of population growth as well. It's just a larger city. And then up in Missouri, I think the median home price at this point right now is around 180. And so the neighborhoods that I'm buying in where I get up to about 130 on that price point, that's that entry level middle class still. And those people are making 40 to 55K on the high end.
Got it. And do you have kind of an underwriting standard percent of income you guys
Yeah,
underwrite
absolutely. Yeah, they need to make at least three times. Their gross income needs to be at least three times the monthly rent to ensure that they can, afford the property. We're doing background checks on all these tenants. I'm pushing for multi-year leases on these tenants as well. We're usually pushing for 2 years across the board. There's certain circumstances where I'll allow a 1 year if it's a really outstanding application, and they have a good reason as to why they only want to do a 1 year. But it's my goal to just put the best type of tenants in these properties, the best quality tenants, because I know if I'm putting good tenants in the properties, they will perform.
Sure. Well, now I like the 2 year rental agreement that keeps your turn cost down. I mean, that's that's one thing I keep. My experience has been is that the turn cost on a single family is just significantly greater than on the kind of a multifamily. You've got it's just a bigger property and yard and all that other stuff.
Yeah.
It can add up in a hurry.
No, yeah, good point. And so, we try and limit that stuff on the front end. We do very durable renovations of the properties. I have a general standard for our GCs to where, if that roof doesn't have, at least 10 years left of life. So I'm looking at something. If it's in 1/3 of its life, I'm going to leave it. If it's something where it's like 2/3 into the life, we're replacing it. We can't have the mentality that if it's not broke, we're not going to fix it. Now we're selling turnkey properties to investors. So like I said, starts with that roof, need to have at least 10 years left on it. Same thing for the HVAC. Hot water tanks, usually I'm replacing. They're not very expensive to replace anyway, and you're going to get a good 12 years out of a new unit. So we start off with that. And then, like I said, just acquiring better quality tenants that make better income, just like that kind of higher level person. They're going to take better care of the home. And so we don't run into big turn costs and things like that. Sure, things are going to happen down the line. You're always going to have replacement costs and capital expenditures, but we try and limit all that stuff, at least early on in ownership for sure. Within the first 5 to 10 years, you shouldn't have to really replace anything major.
Got it. Where do you guys find your properties?
All over the place. MLS, I can still do MLS up in Missouri. Some of the flips that we do that could go, that hybrid model that I was speaking of, that it could either go on as a retail flip or as a rental, I can still get those on the MLS here and there. But we've been down here buying cash in Texas for 5 years now, a little over 5 years. So we've built some really good relationships with wholesalers, agents that get pocket listings, things of that nature. So they'll shoot stuff over to us first before they'll put it on the MLS or release it to other buyers or the general public. Just because they know we close cash, we close quick, we don't cause any fuss, and we're consistent. And so if it wasn't for that, I'd be having a really tough time getting inventory. We go to auction every month. In Texas, they only have a auction once a month, Super Tuesday, first Tuesday of the month. So my acquisitions team is driving 40, 50, 60 properties a month just to see, maybe 10 of them actually show up to auction. But we have to drive them all to make sure the foundations are intact, to make sure roofs don't need to be replaced. So we know how much to bid on these homes when we get to auction. We don't want to overbid on something that needs $20,000 in foundation work. And so, with auctions too, a lot of times you can't get into the property. There's the old owner living in there, and we have to go through an eviction process to get them out after we win the bid. And so we don't even know what the inside looks like. And so that's a lot of risk that we're assuming for our investor as well. Sure, you could go do this yourself. You want to fly down here, go to auction, bid on the properties. Do you have time to drive them all and make sure what you're bidding on? And then, do you have the capabilities of, if this property ends up coming in higher than I thought on the rehab bid, can you eat that cost? We can. We do a high volume of homes. So if I miss out on one, fine. I'm selling 20 others that month. We just know that there's a lot of risk involved with acquiring these homes, especially in distressed state. But in today's market, you're not going to get good deals unless you roll the dice and go after some of these distressed properties and go to auction. You just won't get properties in a hot market like Texas.
Right. Let me ask you, at what point do your investors get involved, or are they talking to you up front saying, "Hey, I'd like to get in," or is it you say, "Hey, I've got one that's all fixed up. Would you like this one?" Or can you kind of walk through where the investor gets engaged with you guys?
Yeah, so they come in, they kind of give us an idea of what they're looking for. I start marketing the properties right after I get my bid done. So, for example, let's say I get one at auction, I own it, but I can't market it just yet because we haven't kicked out the owner, we haven't been into the property, we haven't finalized our full scope of work and bid. Once we do that, I start marketing the home. I'll know what my all-in price is. I'll know what it's going to rent for. We've done hundreds of homes down here, close to 1,000 at this point. So we typically know what a 3-2, 1,500, 1,600, 1,700 square foot house is going to be on the rehab side. But even still, once we get the final bid, we know what they're going to rent for. We get the tax cert, so we know what the taxes are. I can start putting the numbers together and putting it into a deal sheet, and I start shopping that out to the investor at that point. What the investor is going to do, they're going to put an EMD down, just a deposit to reserve the property. We're going to get a contract in place, and we don't sell the home to the investor until it's done with the rehab. They've seen the finished photos, it's passed a third-party inspection, and it's ready for a tenant. At that point, we'll move ahead to the closing process. And they have to review all those due diligence items before we proceed to closing anyway. So, for example, let's say they see something on the inspection report they don't like, and maybe I'm not willing to fix it or whatever it is. We can transfer the deposit to another home, or I'll refund it. I'm not in the business of holding people's earnest money deposit. That's kind of a way that we just try and build trust with the investor and make them feel comfortable moving forward with us.
So once you have a property locked up, you market it. The investor says, "Yeah, I'm good. Let's do this one." They give you the EMD, and what EMD? What does that stand for?
Earnest money deposit.
Okay, I was trying to figure some electronic something in there.
And that's gonna sit at the title company. We don't even touch it, but we get a contract in place, we get the EMD in place, and then they're working with my transaction manager until we get to the closing table. So she will be providing weekly updates on where we are with the rehab process. She'll be helping order insurance. She'll be helping with, providing you the finished photos. She will deliver the third-party inspection to you. She'll work with you through all that process. You review everything. We go ahead and get to the closing table as soon as it's ready for a tenant. In Texas, 9 times out of 10, I already have a tenant in place because the market's so hot right now and the inventory is just so low.
How long has it typically taken you from acquisition to renovation completed?
It'll depend on, I'd say average 45 days, but a lot of that has to depend on the year built of the home. I'm able to get a lot of 2000 build and above properties down here in Texas because there was a lot of just, it's a fast growing market and it has been for the past 10, 20 years. So you see a lot of new or relatively new subdivisions that have popped up. So those houses, obviously, I can get done in 2 to 3 weeks, but then we buy all the way down to, late 50s and 60s where those homes just need a lot more work. They need new plumbing. They need a new electrical. They're getting full gut jobs. So those will take about 60 days. Got
it. So you have the investor, they do their deposit, they get the updates, they close. You do place a tenant?
Yes, we have an in-house management solution in all of our markets. So another beautiful thing about working with a company like mine, you will only have one point of contact. I can put you in 4 different markets in America that offer different risks, different rewards based on different things. Like we talked about Missouri being a more higher rate of return, lower barrier to entry. Texas being a little higher barrier to entry, but a little bit more safe, less risk for vacancy, things of that nature, and also a greater appreciation upside. So I can really build these solid blended portfolios. And I tell my investors all the time, this is a volume-based thing. So although these are single-family homes, these investors don't come to me and just buy one property. They buy 5, 10, 20. They're trying to build a portfolio that they could retire on. So that's the goal here. So like I said, I can put you in 4 different markets, diversify you, and you'll only have one point of contact and one management solution watching over all of them. Your online portal that you'll have to track all your investments will just be one portal, whether you own a house in just Dallas or in all 4 of my markets.
Got it. Want to back up one step. Financing. Do you guys are you able to accommodate the financing, or does a buyer need to be a cash buyer, or how's that work?
No, we offer financing on the majority of our properties. Some of them are produced to be geared more towards like a cash purchase, just because of the fact that, I buy some properties where I have to put a lot of renovation into them, and it makes sense for a cash purchase, but it might not necessarily meet the sales price, might not meet appraised value. But myself in Texas, I really don't run into any issues with appraisals. You can go ahead and to get a conventional loan on any one of these homes. So you can buy these properties with 20% down. Rates right now are fluctuating just below 5% with the lenders I'm using. We also have a hard money lenders. So if there's investors out there who are looking to take advantage of like a solo 401k option or a self-directed IRA, if you're going to use any sort of financing, I would recommend structuring it in a solo K. And we have hard money lenders that will loan to that type of investor as well.
Got it. And so you guys manage the property. You get all the calls, whether it be the toilets running or the dishwasher broke or whatever that is. But it sounds like you guys kind of go through that up front to minimize any of those calls. How long, or what do you expect an investor to stay in on an average? What's an average hold for one of your investors?
I would say that's basically my investment coordinators and myself. I speak to a lot of the investors also. I love doing that. I love, strategizing, good investment goal, like plans and goals and things of that nature. So it kind of depends on the property. So the ones that we're doing in the southern part of Dallas, eastern part of Dallas, those are more geared towards rental because they're a little lower entry point. They're about 170 on average, and the ROIs are a bit higher. So I think those ones are just long-term hold plays. I'd hold those forever. Those are going to be good, consistent performers. We're going to consistently be able to keep those rented with good, solid tenants. The ones I was talking about, like in Burleson for 290, some of the ones that I'm able to do in East Plano, some of the ones I'm able to do in more of the northern parts of Dallas, the higher end areas, I think that those are more of like a 3 to 5 year short-term hold. Bank on that appreciation. I really don't see the market slowing down. Plano's like the number one, number two I see all the time in the news. Areas to move to for employment. There's tons of jobs down here, so I don't see that slowing down. And so if that happens, these properties are at least going to hold their value, but I definitely foresee them to continue to appreciate in value. And so on that type of investment, I don't necessarily look at it as a long-term hold. I think, like I said, a 3 to 5 year 1031 or do a cash out refi, something like that, pull some equity out of the property. I think that would be your best bet. And then the stuff up in Missouri and St. Louis, that's definitely a long-term hold play. Those are markets and areas where you're not going to see super high appreciation, but they're very strong ROIs. And I think those you just hold forever. You pass those along to your children.
Right. Do you have a lot of customers that have got out 1031 into something else with you in a different market, or is that a common play? If they get out of one, do they say, "What else you got, John?" Or
Typically, most of my guys right now, they're not pulling out of Texas at this point. They're still hoping that it's going to keep going. And so I've kind of recommended that they still hold still for now. One of my lenders, he bought some properties years back in a little lower end area of this city called Lancaster that's south of Dallas. It's an area I would not personally buy homes in. They're more of like a low B type of investment, lower rents. I think his rents were around $1,000 a month. He wasn't having the best experience. And I really believe that too, in terms of that type of rent and price point in Dallas, you are going to run into a little bit more risk with the tenant. And so he sold them, but he did have equity in them. The prices went up on those homes as well. So he took that money, 1031 into 2 properties with me in DeSoto, another southern suburb of Dallas, where those properties rent for, I think both rented, one rented for 1,600, one rented for 1,700. So he's having a much better experience, obviously, at that class of property.
No, but I'll bet. Kind of curious, do you have any kind of a sense of a rate of return investors are able to get?
Yeah, so in the Missouri market, I'll start with a cash purchase first. So let's say you're buying cash. I'm going to be able to get you 8% plus net returns in that market. Down in Texas, let's go to leverage now. So let's say you do a conventional purchase, 20% down. I can get you on bare minimum pretty much 15%, as high as 20, sometimes even above 20 in that market. Down in Texas, a cash purchase, I'm anywhere from 6% on the low end, up to maybe 7.5 on the high end. And then on a conventional purchase, some of these higher end homes, obviously your principal and interest payment is going to be higher. So even though you leverage, you're still floating around a 6, right? But I could get you in some of the more rental type neighborhoods that I'm buying in the south and east part of Dallas. I can get up to a 12% leverage rate of return. And that's not a really safe investment. Like I said, that's somebody that's going to be living in the home that's making 60, 70K a year in a good middle class suburb.
I got to tell you, I've got my wife and I have a handful of single families and an apartment complex, and I was doing the math. Oh, it's probably been now a couple of months ago, but I was doing the math just comparing a rollover 401k I had compared to this one property, and this property is nothing special. We still have it. It's just a little single family down in a tertiary market. And it's probably a C, market as far as in the tenant. It's just it's not one that I would buy again. But I was just looking at the equity. I mean, when you compare the little bit that I put in, and you compare that to the relatively the same amount of money I put into it was a rollover from a 401k, and the balances are remarkably different. I mean, the real estate is worth easily 4 times what the 401k is, based on just based on the appreciation. And I'm not talking about some stellar market. This is not everybody's beating down the door to get into this market. And it was just it really kind of was a reiteration of just the play of leverage, and
absolutely.
Have the tenant pay down your mortgage, because a lot of that value was built based on them paying down the mortgage. Whereas the 401k was kind of requiring that I keep putting in the money, kind of thing. So it's, I try and tell everybody that, just because it's like when you stop and you realize that the tenant is the one that's actually feeding your investment. Whereas if you're doing the 401k, it's up to you and your withdrawal or your deduction from your paycheck, kind of thing.
Exactly.
The power of
a
leverage.
lot of people, I don't mean to cut you off, a lot of people lose sight of that as well. They want to look at, John, what's my net return? If you're getting conventional loans on these properties, honestly, that's pocket change. We're talking about $250 compared to a market that's higher risk that might get you $400. Well, what is that $150 a month really going to do for you if you're really going into a higher risk type of neighborhood? So really all I do with my net proceeds on these properties that I own with conventional loans on them, I just pay down my loans. I take that money and pay the loans down as fast as I can, because really these things don't fully cash flow and really, start making a lot of money for you until they're paid off. And I believe in leveraging the homes and letting the tenant pay down the principal balance, which is another thing investors kind of lose sight of sometimes. Keep in mind, this is still a win situation for you. Even if you broke even on the deal, you still have someone else in the house paying your principal balance down.
Right.
So, I mean, you can't lose sight of that, really. That is still a win.
Right. No, and then just to play it forward there is, if you say you do pay it down aggressively, you've got the extra that you keep throwing at it based on the little bit you have left over there, and you shorten the term of the loan, and all of a sudden you've got a paid off asset. You've either got the cash flow, or if you want to go buy another one or something bigger or whatever, you can easily walk into the bank with a paid off asset that's producing cash, and leverage that, and it's a very easy process, as opposed to trying to borrow against something that you're trying to acquire, or it can be a totally different conversation, I guess I should say, if you're working with a commercial bank or something like that, as opposed to going through all the other. But no, it's definitely something that I try and share with people, just that get in to real estate, because of just the power of the leverage, and having that tenant pay down your principal there, and growing your equity, even if the market never went up a nickel. I mean, which I don't see that happening, but let's just say it did. You still have that declining balance, which is growing that spread on an investment that you wouldn't otherwise have access to, and just one of many ways to make money in real estate. Well, I I am just thinking through this, and I guess the point that I'd like to reiterate to anybody that's listening is that if you're thinking about getting into real estate, and especially on the commercial side, maybe it seems a little overwhelming, and you've resisted or you can't figure out how to get into it. I cannot recommend enough that you figure out a way to get into something, and whether it be a turnkey and you contact John at American Real Estate Investments, or somehow you get into something. And I will say, I mean, your ability to manage the thing to where there's only one point of contact, you're not having to get those calls and track down that plumber or the handyman, or manage the job and all that, because that stuff does happen, especially if you're the one that's managing it, or you have to be the asset manager if you're not that familiar with the manager. So I'm guessing that familiarity with you and your company is something that your investors really appreciate and enjoy. John, I'm thinking through. Is there anything that we haven't touched on as far as good ways or something about turnkey rentals?
I would just say, just to kind of piggyback off what you just said there. I mean, look, Fannie Mae is loaning money right now, so I would take advantage of it while they are. And the only thing that's going to happen in a healthy economy is interest rates are going to continue to go up. And you look historically, the economy is doing good. These rates are going to be above 6%. Right now, they're still floating below 5%. So the longer you wait, the higher the rate's going to go. And then who knows, we might run into another situation where the banks just say, hey, we're not loaning for a while. So I just think, for right now, while Fannie Mae's just handing out money, take it.
I like it. John, what's the best way for our listeners to find out more about you and get in touch?
The best way would be to contact us on our website. It's www.arei, that stands for American Real Estate Investments, USA, United States of America.com. Got
it. John, thanks for taking the time to talk, and look forward to doing it again soon.
Thank you so much. I appreciate you having me on the show, and maybe we'll do it again sometime soon.
You got it. For our listeners, if you like the show, share the show with someone you know. It's real easy to do. You can just hit the share button and share John's story here and the turnkey investment info. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.